Imagine for a second that you are the CEO of a massively successful corporation.
Okay, I like where this is going.
Right. You have just closed the books on a record-breaking year. You have, let's say, $1 billion in pure, unadulterated profit just sitting in the bank.
A nice problem to have.
Exactly. So you decide you want to reward your loyal shareholders, the people who believed in you. You want to send them a massive cash check.
Makes sense on paper.
It does. You step up to the podium, you announce this massive cash giveaway, and then the moment the words leave your mouth, the stock market immediately punishes you.
Oh, yeah. It crashes.
Your share price just plummets.
Yeah.
Wall Street analysts are downgrading your stock, and financial news anchors are openly questioning your leadership.
It is genuinely one of the most brutal, counterintuitive realities in the entire financial world.
It's insane.
Well,
why on earth does giving away cold, hard cash actually destroy value? And conversely, why do some companies refuse to pay out a single cent for decades, yet their stock price just goes into the stratosphere?
Right. It seems entirely backward.
Welcome to the Deep Dive. If you are listening to this, you are likely navigating the treacherous waters of corporate finance.
Probably an MBA student staring down a really brutal final exam.
Exactly. Or maybe you're just aiming to survive and thrive in a high-stakes boardroom. Either way, our mission today is to completely decode what happens to that $1 billion.
We are looking at one of the most debated, mathematically complex, and heavily tested topics in modern finance.
Right. So to truly master this, we have to look at the architecture of corporate decision-making.
Yeah, every single finance manager, every chief financial officer basically has a job description that boils down to what we call the big three decisions.
The big three.
Right. If you understand these three, you basically understand the engine of capitalism.
Okay, let's lay out that architecture for you. Pillar number one is the investment decision,
which you'll often hear called capital budgeting in your classes.
Yes, exactly. This is the act of looking at the landscape and deciding what real, tangible assets or projects the firm should actually buy to generate future wealth.
Like building a new factory.
Or acquiring a competitor or developing a new software platform. Now, pillar number two is the financing decision.
Because you have to pay for that factory somehow.
Right. How do you pay for it? Do you go to a bank and take on a mountain of debt? Do you issue new equity and dilute your current owners?
Which brings us to the third massive pillar, and, well, this is our entire focus today, the dividend decision.
The big one.
Exactly. Once that factory is built and it actually starts generating a profit, management is faced with a profound fork in the road.
They have to decide whether to distribute those earnings back to the shareholders as a reward or plow them back into the business to fund even more growth.
It's the ultimate balancing act of managing earnings, and it is the exact mechanism by which a company theoretically maximizes shareholder wealth.
And to really grasp the weight of this choice, think of it through like an agricultural lens.
Oh, I love this analogy.
Yeah. Imagine you are a farmer at the end of a phenomenally good season. The silos are completely full. You brought in the harvest.
The hard work is done.
Right. Now, sitting at your kitchen table, you face a really critical choice. Do you and your family eat the harvest right now, enjoying the immediate fruits of your labor?
Which is tempting.
Highly tempting. Or do you take a significant portion of that grain, lock it away, and save it as seed to plant for an even bigger crop next year?
That tension right there between eating the harvest and planting the seeds, that is the dividend decision in a nutshell.
It really is.
Paying a dividend is eating the harvest. It's the portion of a firm's earnings paid directly out to the shareholders.
Giving them a steady, tangible return right now, completely independent of whatever the stock market is doing on any given Tuesday.
Exactly. Saving the seeds, on the other hand, is what we call retained earnings.
But inside a corporate structure, not everyone sitting at the table gets the same say in whether we eat or plant.
No, they definitely do not.
The capital structure of a firm treats different types of owners very differently.
And that is a critical distinction to make early on, especially for the MBA students listening. When we talk about dividends, we absolutely have to separate preference share capital from equity share capital.
Right, preference versus equity.
Yeah. If a company has issued preference shares, the dividend paid on those is almost entirely divorced from this agonizing strategic debate.
Because preference dividends are fixed.
Exactly. They act almost like a contractual liability. It's highly similar to paying the interest on a bank loan. The company knows exactly what it owes preference shareholders, and it just pays it.
So there's no debate.
Right. What's fascinating here is that the real battlefield, The place where financial theory is tested and where boardroom shouting matches actually happen is over the equity share capital.
Because equity shareholders are the residual owners.
Yes, they get whatever is left over after the bills are paid, the debt is serviced, and the preference shares are totally satisfied.
But here's an essential concept to lock into your memory, especially if you're facing an exam right now. Retained earnings are absolutely not just leftover cash sitting idly in a corporate vault.
Oh, far from it. Retained earnings are arguably the most highly strategic internal source of financing a company possesses.
They are the seed corn.
Exactly. If a firm's management identifies a new project that has a positive net present value, meaning the project will generate more value than it actually costs, they need capital to execute it.
Right.
Using retained earnings is fundamentally the most direct, friction-free way to finance that growth. You don't have to ask a bank for permission.
And you don't have to convince Wall Street to buy new stock.
Exactly. So we have this massive tension. The shareholders want cash in their pockets today, but the company wants to keep the cash to build the future.
Which naturally leads to a monumental question. If retained earnings are so incredibly valuable for funding growth, does the act of paying out a cash dividend actually matter to the overall long-term value of the firm?
You would think we'd have a simple answer by now.
Right. After over a century of modern corporate finance, you'd expect a simple yes or no.
But the academic world is spectacularly divided on this. We have to explore the first major camp of thought, which argues that this entire debate is essentially meaningless.
Meaningless?
Yeah. These are known as the irrelevance theories.
Okay.
The core philosophical argument here is that rational investors simply do not care whether they receive their returns in the form of a present cash dividend or as future capital gains via a higher stock price.
They just want their overall wealth to go up.
Exactly. A dollar is a dollar to them.
So the first framework under this irrelevance umbrella is called the residual theory of dividends. And it operates on a brutally logical premise.
Very logical.
The firm exists to make investments. Therefore, the firm should only ever pay a dividend from the literal residual, the exact amount of cash left over after it has fully funded every single positive net present value project available.
Right. Under this theory, management's total focus is on the left side of the balance sheet, the assets and the investments.
So they ignore the shareholders.
Pretty much. Going out to external capital markets to raise money is considered unnecessarily expensive or restrictive. So the company relies entirely on its internal seed corn, its retained earnings.
Meaning the decision to pay a dividend is purely passive.
Completely passive. It is dictated entirely by how many good investment opportunities exist out in the world.
So if you have 10 great projects, you keep all the cash.
Right. And if you have 0 good projects, you pay all the cash out as a dividend. Because it's just a passive byproduct of investment decisions, the dividend itself has no active influence on the market price of the stock.
That makes intuitive sense, but honestly, it's just the warm-up.
Oh, absolutely.
If you want to master corporate finance, you have to face the absolute titan of dividend theory, the Modigliani and Miller approach.
Proposed in 1961 by Franco Modigliani and Merton Miller.
You'll hear it referred to as the approach. And they made a massive sweeping claim. They said the value of a firm is determined purely by its basic earning power and the risk of its underlying assets.
Yep. How it chooses to slice up and distribute those earnings is totally irrelevant to its valuation.
Okay, to grasp the magnitude of what achieved, you have to understand the environment they constructed to prove it.
Because their mathematical proof relies on an airtight, highly specific set of assumptions, they essentially built a theoretical vacuum.
Total vacuum.
First, they assume capital markets are utterly perfect and all investors behave with total rationality.
Second, there are absolutely no taxes and no transaction costs for buying or selling shares.
Right. And third, there are no flotation costs, meaning a company can issue new stock for free without paying investment bankers millions of dollars.
I have to pause right here. Because this is exactly where the academic theory clashes violently with the reality you will face in a real career.
It's a big clash.
Assumes perfect capital markets, 0 taxes, 0 broker fees, and perfect certainty, where every investor knows exactly what future earnings will be.
Yeah, it's pretty out there.
Has anyone, anywhere, ever seen a market like that? It's like a physicist building a bridge based on the assumption that gravity can just be turned off on weekends.
The assumptions are undeniably sterile, I'll give you that. But that frictionless vacuum is absolutely required for their core mechanism.
The arbitrage proof.
Exactly. Arbitrage, in a financial sense, involves entering into two simultaneous transactions that perfectly offset each other, neutralizing any net change.
Okay.
Argued that if a company pays a dividend but still needs money to fund its investments, it will simply raise external capital.
Right.
The wealth given to the shareholder in cash is perfectly offset by the dilution of the company's value when it issues new shares.
Let's visualize this arbitrage process without getting bogged down in the raw algebra, because the intuition is what really matters for an exam.
Visuals always help.
Imagine I have a large pitcher of water.
Okay.
And that pitcher represents the total wealth of the firm. I also have an empty glass sitting next to it, which represents the shareholder's pocket. The theory says that the total amount of water in the system is fixed based on the company's earning power.
Right, the water is the total value.
So if the company pays out a dividend, it is simply pouring water from the pitcher into the glass. The company has less water, the shareholder has more water.
But the total wealth in the room hasn't changed by a single drop.
Exactly. Let's ground that pitcher analogy in the actual mechanics.
Let's use the classic framework from the source material. This is crucial for MBA prep. Imagine a firm currently has 25,000 shares outstanding.
Okay, 25,000 shares.
And they're trading at 100 rupees a share. The company expects to generate 250,000 rupees in pure earnings this year.
Got it.
However, management has found an incredible new investment project that requires 500,000 rupees to launch. And simultaneously, they're considering paying a 5 rupee per share dividend.
Okay, let's track the cash step by step.
Right.
If they pay 5 rupees on 25,000 shares, that is 125,000 rupees flying out the door to shareholders.
Right. But remember, the company only earned 250,000 rupees total.
Right.
So after paying that dividend, they only have 125,000 rupees left in retained earnings. But the new factory costs 500,000.
So they have a massive shortfall.
Exactly. They are 375,000 rupees short. Because we are in MM's frictionless vacuum, the company simply goes to the market and issues new shares to raise that exact missing amount.
But here is the critical pivot of the theory. Listen closely to this.
Yeah.
Because the company just gave away a huge chunk of its cash, the fundamental value of the company drops.
Yes.
The stock price isn't 100 rupees anymore. The math dictates that the share price drops by the exact proportion of the value that left the firm.
So the new share price might be, say, 105 rupees instead of the 110 rupees it would have grown to if they had kept the cash.
And that price drop is the offset. To raise that missing 375,000 rupees at the newly diminished stock price, they have to issue a large number of new shares.
Right. They're diluting the ownership of the company.
So when you run the calculation for the total value of the firm at the end of the year, adding up the value of the old shares, the new shares, and the cash paid out, it comes out to an exact figure.
Let's call it 2.5 million rupees.
Okay, 2.5 million. But what if they don't pay the dividend? What if they act like a miser and hoard all the cash?
Well, if they pay 0 dividends, they keep the entire 250,000 in earnings.
Okay.
They still need 500,000 for the factory, so their shortfall is much smaller now. It's only 250,000 rupees.
So they issue fewer new shares.
Exactly. And because cash never left the firm, those shares are issued at a higher price. But when you total up the final value of the firm at the end of the year,
Let me guess.
it is exactly 2.5 million rupees. The value is perfectly identical.
Boom. That is the arbitrage. The value gained by the shareholder holding that 5 rupee cash dividend in their hand is completely 100% neutralized by the reduction in the market value of their existing shares.
Because the firm had to dilute their ownership to fund the new factory, it is a perfect zero-sum game.
That is the genius of Modigliani and Miller.
And the limitation.
Exactly. It mathematically proves that investors should be completely indifferent to dividend policy. But my earlier critique about gravity on weekends is the exact reason this theory faces such heavy fire in the real world.
Yeah, because the vacuum cracks the second you step outside.
Think about the concept of homemade dividends. argues that if an investor wants cash, but the company doesn't pay a dividend, the investor can just synthesize their own dividend by selling off a fraction of their shares.
On paper, that works perfectly.
But in reality, if you or I want to sell 10 shares of a stock to generate some cash, we have to log into a brokerage.
Right.
We have to pay a trading fee. We have to deal with bid-ask spreads. And then, worst of all, we trigger a capital gains tax event.
It is absolutely not frictionless.
Not at all.
The transaction costs alone destroy the perfect arbitrage. Furthermore, assumes companies can just issue new stock for free.
Which they can't.
Right. In reality, issuing new equity costs millions in underwriting fees, legal fees, and regulatory compliance. This is known as flotation cost.
Okay, so when a firm pays a dividend and is then forced to issue new stock to replace that capital, the firm loses massive amounts of wealth to investment bankers and lawyers.
Precisely. And most importantly, assumes perfect certainty.
Oh, this is a big one.
They assume the investor looks at a cash dividend today and a promised stock price increase tomorrow and values them completely equally.
But human beings don't work like that. We're anxious creatures. We stress out about the future.
Which serves as the perfect bridge into the opposing academic camp. Because perfect markets don't exist, we must explore the relevance theories.
Relevance, right?
These are the frameworks built on the premise that the dividend decision actively, fundamentally alters the total value of the firm.
And the gateway into this camp is James E. Walter's approach.
Walter's model is an absolute staple of corporate finance.
It is built on a very elegant, very simple comparison. If you are preparing for an exam, this has to be your anchor.
Yeah, Walter looked at two vital rates. First, the firm's internal reinvestment rate, which we call R.
Lowercase r.
Right. This is the rate of return the company can generate on the cash it keeps inside the business. Second, he looked at the cost of equity, or KEY.
Case of D.
Exactly. This is the rate of return the shareholders expect, or the rate they could earn if they took their money elsewhere in the market.
So by comparing R to KEY, Walter categorized all companies into three distinct profiles, each with a mathematically optimal dividend policy.
Let's break them down. The first profile is the growth firm. This is a company where R is significantly greater than KEY.
Okay, R is greater.
Yes. The firm is a compounding machine. It generates vastly better returns internally than the shareholders could ever achieve on their own in the open market.
So for a growth firm, the optimal payout ratio is a hard 0%.
Zero.
It is actually irresponsible for the firm to pay a dividend. Think about it. If you are holding shares in a revolutionary tech startup that is earning 30% on its internal investments, and your personal portfolio only earns 8%.
You want that startup to keep every single penny.
Exactly. Walter's formula mathematically proves that for a growth firm, the market value of the equity is maximized when the dividend is zero, because that internal growth engine capitalizes into a massive future share price.
Now, the second profile is the normal firm. Here, R exactly equals KEY.
Okay, they match.
Yeah. The company is earning the exact same rate the shareholders could earn on their own. In this specific scenario, Walter's model actually aligns slightly with The dividend payout ratio is irrelevant.
Irrelevant.
Right. Whether the firm retains the earnings or pays them out, the wealth generated is identical, so any payout ratio is optimal.
But the third category is where the model gets really prescriptive. The declining firm.
This is where R is less than KEY.
The company's internal operations are stalling out. They're earning a lower return than the broader market. It makes absolutely no economic sense for this firm to retain earnings.
They are literally destroying shareholder wealth by keeping the cash trapped in a suboptimal business.
So what's the optimal policy?
Therefore, the optimal payout ratio for a declining firm is 100%.
Wow, 100%.
Distribute every last drop of the earnings, force the capital back out into the market so the shareholders can deploy it more efficiently elsewhere.
It is a highly logical framework.
Right.
But like it definitely has blind spots.
It does. Walter assumed that R and K remain constant forever.
Right.
But we know that as a firm pumps more and more money into investments, the law of diminishing returns kicks in and R will inevitably fall.
And as the firm's risk profile changes, the shareholders will naturally adjust their K.
Exactly. That dynamic shifting of risk leads us to the next massive pillar of relevance theory, Gordon's approach.
Developed by Myron Gordon and John Lintner.
Yes. This framework injects pure human psychology into the cold mathematics of finance. It is famous for the bird in the hand argument.
I love this one.
Gordon fundamentally rejected MN's assertion that investors are indifferent between current cash and future capital gains. He argued that shareholders are inherently risk-averse. They look at the future, and they see a fog of uncertainty. Will a company's new factories succeed? Will a competitor disrupt the market? Will the whole economy crash?
It all comes down to the anxiety premium.
Yes.
$1 of dividends sitting in my bank account today is safe. I can see it, I can spend it, I can use it to buy a sandwich.
It's real.
But $1 retained by the company for some theoretical future project, that might evaporate if management makes a mistake. As the old proverb goes, A bird in the hand is genuinely worth more than two in the bush.
And Gordon managed to model this psychological preference mathematically.
How so?
Because a current declared dividend is considered a near certainty, investors view it as low risk. Therefore, they discount the firm's immediate dividend stream at a lower rate of return.
Okay, that makes sense.
Conversely, future capital gains are highly uncertain, so investors apply a much higher discount rate to those. If a company commits to higher current dividends, the overall discount rate applied by the market drops.
And the present value of the firm's shares increases. If you reduce the anxiety of the investor, you reduce their required rate of return, and your stock price goes up.
Gordon's constant growth model arrives at the exact same operational conclusions as Walter. 0 payout for growth firms, 100% for declining firms. But the why is entirely different.
It's not just about internal rates of return anymore. It's about soothing the psychological fears of the market.
And that psychological element opens up one of the most fascinating phenomena in corporate finance: dividend signaling.
Signaling.
If we connect this to the bigger picture, we have to acknowledge an information asymmetry. The CEO and the board of directors possess vastly more information about the company's true health and future prospects than the public market does.
They see the real books.
They do. So dividends become a massive, undeniable megaphone. When a company's board announces an unexpected increase in their regular dividend, it sends a shockwave through the market.
Why?
Because you don't commit to permanently sending more cash out the door unless you are absolutely deeply confident that your future cash flows are sustainable enough to cover it.
It is management literally putting their money where their mouth is.
Yes. The signal is loud and clear. We are thriving. And the market almost always rewards that signal by driving the share price up.
But the inverse is equally powerful and terrifying for management.
Oh, yeah.
A dividend cut is the ultimate red flag. Because boards know how much investors value stable dividends, they will do almost anything to avoid cutting them.
They will take on bad debt just to pay a dividend sometimes.
Exactly. If a board finally capitulates and slashes the dividend, it is a glaring signal that the company's internal projections are just dire. The market interprets a cut as management hitting the panic button.
And the share price will violently re-rate downwards. This empirical reality, the intense, immediate price reaction to dividend announcements, is probably one of the strongest arguments against the irrelevance theory.
Because if it was irrelevant, the market wouldn't panic.
Exactly.
Okay, we spent a lot of time in the academic clouds. Let's bring this down to the actual boardroom table.
Let's do it.
How does a chief financial officer, sweating under the fluorescent lights, actually craft a real-world dividend policy? I mean, they aren't just plugging numbers into Walter's formula on a whiteboard. They are balancing intense competing forces.
They are essentially balancing two primary objectives. First, they must view the dividend decision through the lens of long-term financing.
Right.
They have a strict fiduciary duty to retain enough funds to ensure the company can survive and grow.
So that's the planting the seed part.
Right. Second, they are tasked with wealth maximization, knowing that paying current dividends can immediately boost the share price and satisfy their owners.
The eating the harvest part.
Exactly. And to find that perfect equilibrium, a CFO must navigate 6 major practical factors.
Yeah, the source material lays these out beautifully. The first is the payout ratio itself, just the raw percentage of net earnings distributed.
Very straightforward.
But the second factor is where the rubber meets the road for retail investors: stability.
Stability doesn't necessarily mean the dividend never changes. It means the payment is predictable and reliable, which directly attacks that uncertainty Gordon warned us about.
Right, soothing the anxiety.
The literature highlights 3 specific mechanisms for achieving stability. Let's look at them as boardroom dilemmas. Dilemma 1, the constant dividend per share.
Yeah, constant per share.
Management commits to paying, say, exactly 10 rupees per share every single year, regardless of short-term earnings volatility.
So if they have a bad quarter, what happens?
They dip into their historical reserves to keep the dividend at exactly 10 rupees.
Wow. Okay, dilemma 2 is the constant payout ratio. Here, the company ties the dividend directly to its performance. They commit to paying out exactly 40% of their earnings.
So if profits double, the dividend doubles.
Right. But if profits get cut in half, the dividend gets slashed in half.
Which can induce panic.
Yeah. And dilemma 3, the constant dividend per share plus extra.
This is a hybrid approach.
Right. The firm guarantees a low, incredibly safe baseline dividend, say 5 rupees. They know they can pay this even in a severe recession.
It's rock solid.
But In years where they experience massive windfall profits, they declare a special or extra dividend on top of that baseline.
Now, think about this from the perspective of the clientele effect. This is a crucial vocabulary term for exams.
The clientele effect.
Yes. It argues that a company doesn't just pick a policy in a vacuum. Its policy actively attracts a specific type of investor.
A clientele.
Right. If you are a retiree living on a fixed income, using your portfolio to pay for groceries and electricity, which of those three stability models are you looking for?
The retiree is going to flock entirely to the constant dividend per share.
Obviously.
Their grocery bills don't drop by 40% just because the company had a bad quarter in Asia.
Yeah.
They require absolute predictability.
Right. And this raises an important question. If a company has spent 20 years building a clientele of retirees based on a constant dividend, and the CEO suddenly shifts to a constant payout ratio because earnings are volatile,
Oh boy.
they aren't just changing a math formula. They're effectively evicting their current owners.
The retirees will just panic sell the stock.
The price will crash, and the stock will languish until a new clientele of risk-tolerant investors steps in to buy it. It is a highly disruptive, painful transition.
Which perfectly illustrates the third factor, owner's considerations. A board must cater to the realities of who actually owns their stock, particularly regarding taxes.
Yes, taxes. In the vacuum, taxes don't exist. In reality, the tax code dictates almost everything.
In many jurisdictions, dividends are taxed as ordinary income at a very high rate, while capital gains, the profit you make from selling the stock later, are taxed at a much lower, favorable rate.
Right, so if a company is owned primarily by ultra-wealthy investors in the highest tax bracket,
Those investors might explicitly demand a zero dividend policy.
exactly. They want the company to retain everything, grow the stock price, and let the investors trigger a low tax capital gain only when they are ready to sell.
But the boardroom constraints don't stop at taxes. You have legal and contractual constraints.
You physically cannot pay a dividend if the company is insolvent.
Right. The law requires dividends to be paid from actual profits, not by draining the base capital of the company. And if you have debt, well, watch out for the bondholders.
Oh, bondholders are terrified of dividends.
Think about it. If a bank lends a company $100 million, the bank's absolute worst nightmare is the CEO taking that cash and immediately distributing it to the shareholders as a dividend.
Leaving the bank holding an empty shell.
Exactly. So loan agreements are packed with restrictive covenants. They legally bind the company, forbidding them from paying dividends until certain liquidity and profit thresholds are permanently maintained.
And finally, a factor that is intensely relevant today: inflation.
Yes, how does rising inflation impact a CFO's willingness to sign a dividend check?
Inflation acts as a massive anchor on dividend payouts. Think about the accounting mechanics of depreciation.
Okay, let's walk through it.
A manufacturing company buys a machine for $1 million. Over 10 years, they depreciate it, creating a non-cash expense that essentially sets aside $1 million to replace the machine when it breaks down.
Standard accounting.
But in a high inflation environment, 10 years later, that exact same replacement machine now costs $3 million.
The depreciation funds are hopelessly inadequate.
Precisely. To bridge that massive $2 million gap, the company is forced to aggressively hoard its current cash flow.
They have to save more seats.
Yes. They must rely heavily on retained earnings just to maintain their current operational capacity, let alone actually expand. In periods of structural inflation, you will consistently see aggregate dividend payout ratios decline across the broader market.
So we have all these competing forces: taxes, inflation, clienteles, signaling. Let's see how this all collides in a specific real-world environment.
The source material spent significant time analyzing the Indian corporate landscape.
And it reveals a really fascinating psychological divergence.
It does. The Indian market context provides a brilliant case study in market friction and investor psychology.
Historically, and particularly during prolonged bullish market cycles, the source notes that Indian investors largely view dividends as totally inconsequential.
The retail market there possesses an almost obsessive focus on capital appreciation.
The goal is total return.
Right. When the broader market is growing at 15% or 20% a year, an investor simply isn't concerned with a tiny 1.5% dividend yield.
But if the investors don't care, why do Indian corporations bother paying them at all? Why not just retain 100% of the earnings and fuel leverage-free growth?
Because of the signaling terror we discussed earlier.
The megaphone.
Exactly. Even if the investors don't actively seek the dividend, if a company voluntarily cuts an existing dividend, the market still interprets it as a sign of hidden catastrophe. So companies get locked into maintaining payouts they might otherwise prefer to just retain.
But the text digs even deeper into the structural logic of payout levels. Why might a firm deliberately choose a policy of higher dividend payouts, even if it means they constantly have to raise external funds for new projects?
It comes down to a powerful concept called agency costs.
I love this concept. Let's define the agency problem for the students. It is the inherent conflict of interest between the hired management of a company, the agents, and the actual owners, the shareholders.
Management might be tempted to use retained earnings to build an empire.
Right. Buy corporate jets, overpay for acquisitions, or fund pet projects that boost their ego but completely destroy shareholder value.
And the shareholders know this. So how do you discipline a management team that has $1 billion in cash?
You strip them of the cash.
Exactly. By demanding a high dividend payout policy, the shareholders force the free cash flow out of the company. When the CEO inevitably needs capital to build a new factory, they can't just use internal funds silently.
They're forced to go to the external capital markets.
And going to the market is a brutal process. If a CEO wants to issue new bonds or equity, they have to open their books to investment bankers, credit rating agencies, and institutional investors.
They have to justify the new project in excruciating detail.
Exactly. Forcing the company to rely on external financing subjects management to intense, constant scrutiny from the smartest people in the financial sector.
This drastically reduces the agency problem. High dividends act as a policing mechanism on management.
Add to that the psychological reality we mentioned earlier. Despite what says about homemade dividends, human beings viscerally hate selling off their principal shares to generate cash.
The psychological comfort of receiving a cash yield without diminishing your share count heavily biases investors toward demanding higher dividends.
Okay, so agency costs and human psychology pull the payout ratio UP. What forces pull the payout ratio down in, favoring high retention?
We've touched on it briefly. Market friction. Specifically, transaction costs.
The friction can be devastating to compound growth. Think of paying a dividend like an airport currency exchange kiosk.
The worst.
Right. Every time the money crosses the counter, the middleman takes a cut. If a company pays out a dividend to an investor who doesn't actually need the cash right now, that investor gets hit with an immediate tax bill.
Yep, government takes a cut.
Then, if the investor wants to put that money back to work, they reinvest it in the market, paying brokerage fees and bid-ask spreads.
The broker takes a cut.
The wealth is just bleeding out of the system.
And it bleeds from the corporate side, too.
Yes.
If the firm pays out all its cash in dividends and then realizes it needs to build a factory, it has to issue new stock. The investment bankers take a massive cut in underwriting fees. The lawyers take a cut.
If the firm had simply retained the earnings in the first place, the capital would have remained perfectly intact, immune to taxes and banking fees.
Therefore, severe transaction and flotation costs heavily dictate a policy of low dividends and high retention.
Okay, let's assume a board has navigated all of this. They've dealt with the clienteles, the taxes, the agency costs. They have officially decided to distribute wealth to the owners.
This brings us to the actual mechanics of the payout. Because when we say dividend, everyone assumes a cash wire hitting their brokerage account.
Usually, yes.
But there are actually 5 distinct forms a dividend can take. Let's review these for the exams.
The most prevalent, obviously, is the cash dividend. The board formally resolves to pay a specific monetary amount per share.
Within this, we see the regular dividend, which is paid annually or quarterly after the final accounts are audited and cleared.
But boards also have the power to issue an interim dividend.
What's an example of that?
Say a company experiences an unexpected windfall mid-year. Maybe they sold off a subsidiary for a massive profit. They might declare an interim dividend before the final annual meeting.
Form number 2 is the stock dividend. Instead of cash, the company issues additional shares of its own common stock to the existing shareholders, completely free of charge.
Now, a crucial technical detail for your MBA exams, under standard accounting rules, if the company issues a small number of new shares, specifically less than 25% of the total previously outstanding shares, it is classified and accounted for as a stock dividend.
We will dive into what happens if it's over 25% in just a minute.
The third form is where corporate finance gets genuinely creative, the property dividend.
A company is not legally restricted to paying dividends in cash or its own stock. It can issue a non-monetary dividend using physical assets, inventory, or securities of other companies that it currently hold on its balance sheet.
This is one of my favorite examples from the source text, example 13.4. It illustrates perfectly that a dividend is ultimately just a transfer of the firm's assets to the owners.
Imagine you hold a large block of stock in ABC International. You wake up on the payment date expecting a cash deposit. Instead, a specialized climate-controlled delivery truck backs into your driveway, and handlers unload a signed, authentic print by Pablo Picasso.
It sounds absurd, but it highlights the pure accounting mechanics of wealth transfer.
Let's walk through exactly how ABC International has to process that Picasso dividend on their books, because it requires multiple steps.
First, we have to understand the timeline. The process starts on the declaration date. This is the day the board of directors passes a legally binding resolution to pay the dividend.
The moment it is declared, it ceases to be just an idea. It becomes a legal liability of the corporation.
So, on the declaration date, ABC International looks at its vault. They have 500 Picasso prints. They bought them decades ago for a total historical cost of $500,000.
But art appreciates. The current fair market value of those prints is $4 million.
They cannot distribute the asset based on its old historical cost. The first accounting entry on the declaration date is to mark the asset up to reality.
Okay, what's the entry?
They debit the long-term investment's artwork, account for the $3.5 million difference, and they credit a gain on appreciation of artwork for $3.5 million.
The company formally recognizes the wealth it created by holding the art. The art is now officially on the books at $4 million. Step 2. Declaring the actual dividend.
Still on the declaration date, they must reflect the wealth that is about to leave the firm. They debit retained earnings for the full fair market value of $4 million, pulling the equity out.
And they credit a liability account called Property Dividends Payable for $4 million.
Now, a quick detour on the timeline. After the declaration date comes the ex-dividend date. This is vital for anyone trading the stock.
The ex-dividend date is exactly 4 business days before the date of record. If you buy ABC International stock before the ex-dividend date, you are legally entitled to receive the Picasso print.
If you buy the stock on or after the ex-dividend date, the previous owner gets a Picasso and you get nothing. The stock trades ex or without the dividend.
Exactly. And finally, we arrive at the payment date. The delivery trucks are dispatched.
The accounting is simple here. The company debits the property dividends payable liability, zeroing it out because the obligation is fulfilled, and they credit the long-term investments artwork, account for $4 million.
Permanently removing the Picassos from the corporate balance sheet. It is a highly complex, beautifully clean transfer of an illiquid asset.
Okay, moving from fine art to the fourth form, the scrip dividend.
This occurs when a company desperately wants to declare a dividend to satisfy its clientele, but they're facing a severe short-term liquidity crunch. They literally do not have the cash on hand.
So they issue scrip. A scrip dividend is effectively a promissory note.
It is an IOU issued to the shareholders stating, we owe you this dividend and we promise to pay it in cash at a specified future date.
Because the shareholders are being forced to wait, the scrip usually carries an interest rate to compensate them.
They are literally issuing debt to pay a dividend. That is a massive signal of cash flow distress.
And the fifth form is the liquidating dividend.
A liquidating dividend is unique because it does not come from retained earnings.
Right. It happens when a company is winding down operations, selling off its assets, and returning the original base capital back to the owners. The accounting debits, the additional paid-in capital accounts, completely dismantling the financial structure of the firm.
Okay, from cash to stock to Picassos to IOUs to liquidations, that covers the 5 forms. But I want to circle back to the stock dividend because it leads us directly into our final major concept.
What happens when a company wants to reward shareholders, signal immense confidence, but absolutely must conserve its cash to fund growth?
They execute financial magic tricks, specifically bonus shares and stock splits.
Let's start with bonus shares, which is the standard terminology used in the Indian market for a large stock dividend.
When a company issues bonus shares, it is allotting additional shares to its existing shareholders without demanding any payment in return.
If you own 100 shares and they announce a 1-for-1 bonus issue, you wake up the next day with 200 shares.
But where do those new shares come from? You can't just create value out of thin air. Explain the actual capitalization process. What is shifting on the balance sheet?
The total equity of the firm doesn't change by a single rupee. What changes is the internal classification of that equity.
Okay.
The accountants take funds that were sitting in the reserves and surplus account, which represents accumulated historical profits, and they permanently transfer those funds into the share capital account.
The issue of bonus shares results in the capitalization of profits. The profits become permanent, locked-in capital.
Crucially, no cash leaves the firm. And because the new shares are distributed proportionately, your percentage of ownership hasn't changed at all.
If you owned 1% of the company before the bonus issue, you still own exactly 1% of the company after. Your wealth hasn't actually increased.
It's like having a large pizza cut into 8 slices. The company issues a bonus, and now the pizza is cut into 16 slices. You have twice as many slices, but you do not have any more pizza.
The source text rightly calls it a financial gimmick regarding shareholder wealth. But it is a gimmick with immense strategic utility for management.
First, as we noted, it conserves vital cash. Second, it alters the trading dynamics of the stock by dropping the price into a more accessible range.
If a successful company's stock has grown to 10,000 rupees a share, a retail investor might not be able to afford a single share. Trading liquidity dries up.
By issuing a 1-for-1 bonus, the price halves to 5,000 rupees, inviting a flood of new retail investors into the market, which can often drive the total value up slightly due to increased demand.
But the most fascinating strategic reason for a bonus issue is political camouflage. The text points out that a highly successful company might issue bonus shares specifically to manipulate and lower its earnings per share, or EPS.
Why on earth would a CEO want their company to look less profitable on a per-share basis?
Because astronomically high EPS can make a company a target. Imagine a corporation earning 500 rupees per share.
When the labor union looks at that massive number, they assume the company is hoarding wealth, and they demand massive wage increases or threaten to strike.
When consumers see that number, they feel they are being price gouged, leading to boycotts or demands for government regulation.
It paints a giant target on your back.
Exactly. By executing a massive bonus issue, you double the number of shares. Instantly, the EPS drops from 500 rupees to 250 rupees.
The total net income of the company is identical. The total wealth of the owners is identical. But optically, the company looks far less greedy. It disperses the political and social heat.
That is brilliant boardroom maneuvering. But here is a critical distinction you must know, especially for an MBA exam.
You have to be able to explain the precise difference between a bonus issue, a large stock dividend, and a stock split.
Economically, to the investor, they look identical. You get more shares, and the price drops. But the accounting behind the scenes is completely different.
The defining difference revolves around the par value of the stock and the treatment of the reserves.
In a bonus issue, the par value of the individual share remains completely unchanged. If the stock had a par value of 10 rupees before the bonus, every new share also has a par value of 10 rupees.
Because you're creating more shares with the same par value, the total share capital account increases. To balance the accounting equation, the company must drain its reserves. A bonus issue capitalizes the reserves.
Got it. And a stock split.
In a stock split, the par value of the stock is proportionately sliced. A single share with a 10 rupee par value is literally split into 2 shares, each with a 5 rupee par value.
The total par capital remains exactly identical.
Because the total capital hasn't changed, there's absolutely zero need to capitalize the reserves. The reserves and surplus account remains completely untouched.
That is the gold standard answer for your exams.
Yeah.
Unchanged par value requires capitalizing reserves. That's a bonus issue. Reduced par value requires no capitalization. That's a stock split.
But before a CEO decides to use this gimmick to lower their stock price, they need to be aware of a massive compounding trap associated with bonus shares.
It is a trap burn of historical expectations. Once a company issues bonus shares, its official permanent capitalization increases.
Historically, the clientele of that company will expect management to maintain the exact same dividend rate on their new, larger number of shares.
Let's do the math on that trap. If I own 100 shares and the company historically pays a 10% dividend, I am happy.
Right.
The company issues a 1-for-1 bonus. I now own 200 shares. I am not going to accept a 5% dividend. I expect that 10% rate to apply to all 200 of my shares next year.
And that expectation puts terrifying compounding pressure on the company's future cash flows. If earnings do not double to support that new dividend burden, the company will be forced to cut the dividend rate,
triggering the massive negative signaling effect we discussed earlier.
Therefore, a bonus issue should never be undertaken lightly. It is a permanent commitment to higher aggregate cash payouts in the future.
We have covered an immense amount of ground today. We started at the kitchen table, deciding whether to eat the harvest or plant the seeds, the fundamental choice between dividends and retained earnings.
We walked through the perfect, frictionless vacuum of Modigliani and Miller's irrelevance theory.
Proving that in a world without taxes or brokers, giving away cash just forces you to dilute your equity.
We then shattered that vacuum, exploring Walter and Gordon's relevance theories.
We saw how the reality of risk aversion makes a bird in the hand worth more than two in the bush, and how the megaphone of dividend signaling can send a stock soaring or crashing based purely on the confidence of the board.
We sat in the CFO's chair, balancing the demands of retirees who need constant stability against the reality of inflation eroding our depreciation reserves.
We looked at the unique psychology of the Indian market, where dividends act as a policing mechanism against rogue management through agency costs, while transaction fees act as a leaky bucket bleeding wealth.
And finally, we explored the creative mechanics of wealth transfer, from delivering Picasso prints to capitalizing reserves through bonus issues to politically camouflage massive profits.
It is a vast interconnected ecosystem. But if you can internalize these mechanics, the tug-of-war between internal return rates, the cost of equity, tax friction, and human anxiety, you are no longer just memorizing formulas.
You understand the profound strategic weight of the dividend decision.
And I want to leave you with a final provocative thought. We have spent this entire deep dive looking at complex corporate finance, arbitrage proofs, discount rates, and par values.
The hard numbers.
But when you step back and look at the big picture, when you look at the clientele effect, forcing companies to cater to specific demographics, when you look at Gordon's theory built entirely on soothing human anxiety.
And when you witness the absolute visceral terror a CEO feels at the thought of signaling a dividend cut.
It forces a reevaluation of the entire discipline. Is the dividend decision ultimately less about precise financial mathematics and actually just a grand high-stakes exercise in human psychology and managing expectations?
The math is just the language we use to quantify human fear, confidence, and control.
Think about that the next time you look at a stock's dividend yield on your screen. It is never just a number. It is a story. Good luck in the boardroom. Good luck in your exams. Keep questioning the models and keep diving deep.